Well, let's talk about the 2% target, because the 2% target is, believe it or not, a number that was just arbitrarily set. Food prices are expected to go up by another 5 to 7% next year. The yield curve inversion is the widest it's been since the early 1990s, which is usually an indicator of a recession. And at least one Wall Street strategist is suggesting that inflation could remain above 5% for at least the next decade, which has many people concerned about inflation and where exactly we are headed. Because right now there's a significant struggle between inflation, jobs, and interest rates. And as interest rates start to increase, that struggle is going to be more and more real for more people, especially as the cost of borrowing continues to rise and things get more expensive across the board. But the question is, what does the next few years of inflation really look like? And longer term, what does the next decade really look like? And I think there's a little bit of room for perspective on this other than what the mainstream media is suggesting. But before we get into it, my name's Nolan Mathias, and if you want to thrive financially, this is the place for you. So go ahead, click that subscribe button and hit that like button so more people like you can see this video. Okay, so let's talk about inflation. How much inflation can we expect and how long is this really going to go on for? And I think disappointingly, the answer is longer than what a lot of people expect. Because even with rising interest rates, what we've done is we've stabilized the inflation in the economy. In other words, we've stopped it from going up, but we haven't made a lot of inroads with respect to reducing it. And in order to reduce it, like I've said in other videos, which I will link to at the end of this one, it's going to be very hard for us to find ourselves in a situation where inflation is going down unless we do catastrophic damage to jobs. And that has a whole bunch of ramifications, including what it would do to the economy and what it would do politically to the people in power, which is going to play an important role in what happens in inflation in the next 5 to 10 years. And like I said in the intro, this has at least one Wall Street strategist suggesting that having 5% inflation for the next decade would actually be the most reasonable way of deleveraging the economy. And not only that, it would reduce the inequalities associated with higher interest rates and create the least painful, softest landing for the majority of people. But don't just take my word for it. Check this out. This is the actual article from Bloomberg with Vincent Delyard, who's with StoneX Capital, suggests that we should be looking at longer term, a higher rate of inflation. And I want to show you a few of the key points here. So first of all, he points out that the Fed's 2% target is a made-up number. It is there to provide stability, price stability more than anything, and it's something that we've just stuck with since about 1997 because it works. And I think if there's anything that we can see very clearly right now, it's that this isn't working anymore, because with higher interest rates is coming higher borrowing costs, which means more stress on a lot of consumers. Most often, they are the consumers that have the least amount of financial wherewithal to be able to withstand these higher interest rates. And that is going to lead to some pretty ugly stuff coming in the economy. And more specifically, some pretty politically toxic stuff for the politicians in both Canada and the US. And in this article, which is basically an excerpt of a podcast that he did, he basically comes out and says that what goes up is not necessarily going to come down. And he's not convinced that inflation is going to come down anytime soon. And he goes on to say that he does think that we should raise the target to 5% and that ultimately the pace of interest rate hikes is irrelevant. And he suggests that this wouldn't be the worst thing for the world to get rid of that 2% target. And he makes the case that what really hurts is when you have inflation above 10%. Or really unpredictable inflation. And this is very much true. All of the pain that has ever been felt from inflation was not due to inflation rates that were under 10%. It was when inflation rates exceeded 10% and were highly unpredictable. And highly unpredictable inflation is a hallmark of what we call hyperinflation, which, by the way, isn't what we are experiencing right now. Hyperinflation is when inflation is going up at significant levels. I'm talking 30 to 50 to 100%, typically in a month or two span. That is what the definition of hyperinflation is. So relative to the other things that would happen, like I said, that politically toxic idea of super high unemployment, 4 to 5% inflation is really not that bad. And I think if you ask yourself, I had to choose between having a job or having prices that increase by 4 to 5% inflation, I think most rational human beings would suggest that they are willing to deal with 4 to 5% inflation if it means that they continue to have a job and are therefore able to continue to pay their bills, especially if wages are increasing at that same rate. Now, this might make you wonder, why the heck would somebody suggest 5% inflation when we know that 2% is supposed to be the target? Well, let's talk about the 2% target, because the 2% target is, believe it or not, a number that was just arbitrarily set. And it wasn't arbitrarily set by a majority of economists. It wasn't arbitrarily set by any major central bank. It was arbitrarily set by a New Zealand politician when he was put on the spot in a media interview. That's right. The whole 2% inflation target is purely because a reporter asked a finance minister what he thought the target should be, and that finance minister responded it should be in the 1% range. Now, you might be asking, if he said 1%, why did we end up at 2%? Well, it turns out there was some rounding involved with respect to the range that the central bank should be targeting inflation at. Now, this all happened in 1997, and subsequently, New Zealand set their 2% inflation target rate, and Canada was the second country in the world to go ahead and set the same 2% target. Then the Bank of England followed suit, and now, just as a general rule, it is a standard for most central banks to target 2% inflation. But what did they do before that? Prior to that, they targeted the currency values. So in other words, a central bank's primary job prior to the 1990s was to make sure that the currency that they managed not only gained value relative to other currencies, but also didn't lose value relative to other currencies. And this was so important because of the amount of trade that happened in the global economy. And if you found yourself in a situation where your country's currency deviated substantially from other currencies, the country could find itself in a situation where its goods became too expensive or far too cheap to compete against those of other countries, which would have a major effect on the growth in that economy. Now, fast forward to 2023, where inflation is running between 5 and 8%, depending on the metric you are looking at. And the question becomes, what do we do? Well, this is where politics is going to play a major role in what happens in inflation in the long run. Because while inflation is a problem, the primary solution to inflation is to increase interest rates to a point where you find yourself increasing unemployment. And when unemployment starts to increase by even just a little bit, it tends to increase substantially. And the political willpower for this right now is probably not there, especially when you look at the political ideologies that are prominent right now in both Canada and the US, with the Liberal Party in Canada and the Democratic Party in the US. And one of the primary things that those parties are going to be concerned about is higher rates of unemployment. In fact, they have very little appetite for higher rates of unemployment because the majority of people, I think, would rather see 5% inflation and a tight job market than 2% inflation and a job market where a lot of people go unemployed. Because remember, when employment picks up, typically it takes the average person about 3 months to find a new job, which means if you have high unemployment for a period of a year or 2 years or 3 years, you're going to see a pretty significant amount of the population find themselves, at least at some point, in a situation where they no longer have a job. And when people no longer have a job, that means inflation becomes less of a concern and jobs becomes more of a concern. And it also becomes a problem for the political parties involved. So in the US recently, they have shifted to a dual mandate around jobs and inflation. And in Canada, while they have stuck with the 2% inflation targeting, there's also been considerable conversations over the last couple of years around how important jobs are. And I think what you will likely see before you see 2% inflation again is you will see the central banks in both Canada and the US and the federal governments in both of those countries start to shift towards a narrative towards higher inflation rates and the acceptability of 4 or 5 or 6% inflation, as opposed to the more politically toxic conversation around 7 or 8 or 9% unemployment. Now, keep in mind that I'm not trying to make any predictions here. I'm trying to provide perspective, because what the last couple of years has taught us is that you have to expect the unexpected. And my belief is that we're probably going to see some changes in the ideologies around inflation. And more specifically, I think we will see these because when you look at things like the yield curve, which is the widest it's been since the 1990s, this is where short-term interest rates are higher than long-term interest rates and is usually an indicator of a recession. Well, if we are in a place where the bond yields are indicating a recession, and by the way, these are typically very accurate in predicting a recession, well, we're going to have high inflation and a recession at exactly the same time, which could be catastrophic for the economy, especially if we see a high unemployment rate. And when I say catastrophic for the economy, what I mean is we're going to have a lot of very, very, very upset people that aren't going to be able to afford the basic living expenses that are so vital to being able to survive in any economy. So as those conversations around more unemployment start to become more and more frequent, I think we will start to see a shift in the narrative from our central banks. And at the end of the day, the 2% inflation target is something that was designed for one purpose and one purpose only. And it is to provide confidence in the economy, and it is to provide stability. confidence in the fact that things aren't going to get extremely more expensive over the next year or two, so people don't go and start making decisions that lead to even more inflation, because that's what happened in the 1980s. We saw higher rates of inflation as people started to expect inflation and started taking action in order to curb it, which is why that inflation targeting became so important, because higher inflation became a self-fulfilling prophecy. And what will likely happen is as wage inflation starts to catch up to normal inflation, we will start to see the costs of goods, relatively speaking, become fairly comparable to what they were previously. Now, we may end up paying $15 for a whole chicken rather than $10, but relative to what we are making, it will be very similar to what it was in the past. But when we start to take a look at that appetite for a tighter jobs market versus lower inflation, I think the tighter jobs market appetite is going to win out over that of the appetite for lower inflation, which is why I think it is being suggested that 5% inflation for the next decade could very well be the reality for the next 10 years.